As February 2026 comes to a close, the global financial system has officially reached a mathematical event horizon. For decades, the silver market functioned on a gentleman's agreement, a system where trillions of dollars in paper contracts were traded, but the physical metal rarely moved. That agreement just experienced a structural failure. Friday, February 27, 2026, marked first notice day for the March silver futures contract on the COMEX. Historically, this is the largest delivery month of the year, but this time, the numbers transitioned from procedural to existential. The arithmetic is undeniable. As the market moved into this delivery cycle, there were over 400 million ounces of silver tied to March contracts. However, official depository statistics show that registered silver inventories, the bars actually warranted and available for delivery, have plummeted to approximately 88 million ounces. We are now looking at a paper-to-physical imbalance where claims on silver exceed the deliverable supply by more than 400%. This is no longer a matter of market sentiment. It is a crisis of physical liquidity. If even a quarter of these contract holders demand the metal they've paid for, the exchange enters a state of total structural emergency. This is the story of how the March Madness of 2026 became the day the Western paper-silver system was finally exposed. To understand why the COMEX is at a breaking point, we must look at the unprecedented rate of inventory depletion. Since October 2025, total COMEX silver inventories have collapsed by nearly 31%, falling from $532 million ounces to just $366.25 million ounces. But the total inventory figure is a smokescreen. In the COMEX system, silver is divided into two categories: eligible and registered. Eligible silver is metal stored in the vaults that meets exchange requirements but belongs to private owners, ETFs, or banks. It is not available for delivery against futures contracts unless the owner specifically reclassifies it. Registered silver, however, is the metal actually on the menu. It is the only pool available to settle the massive March open interest. On February 11, 2026, the market hit its first major warning sign. Registered stocks slipped below the $100 million ounce psychological floor for the first time since modern records began. By February 27th, that number eroded further to approximately 88.1 million ounces. The velocity of this drain is what has analysts terrified. Withdrawals from Western vaults are currently averaging roughly $785,000 ounces per day. Under normal conditions, only 3% to 5% of futures traders take physical delivery. But February 2026 shattered that norm, with delivery demand reportedly surging toward 98%. Even during the violent price crash in late January, where silver plunged from $121 to $64 in a single week, over $3.3 million ounces were still withdrawn from the vaults. This behavior does not belong to retail speculators. It signals that the world's largest capital allocators no longer trust the paper price and are moving their wealth into physical custody. The current panic was triggered by a period of extreme policy whiplash that began on January 30, 2026. On that day, President Trump nominated Kevin Warsh for Federal Reserve Chair. Known for his hawkish stance on economic policy and his desire to normalize the Fed's balance sheet, the nomination of Warsh initially sent shockwaves through the precious metals market. In a single trading session, silver futures crashed by an unprecedented 39%. The Warsh crash was interpreted as the end of the easy money era, but the correction was short-lived. By February 20th, the Supreme Court of the United States struck down the administration's broad, reciprocal tariffs in a landmark 6-3 ruling. While the removal of legal uncertainty initially caused silver to dip further, the administration immediately launched Plan B. Within hours of the SCOTUS ruling, the government invoked Section 122 of the Trade Act of 1974 to replace the struck-down levies with a 15% global import surcharge on most goods. This surcharge has supercharged what economists call the debasement trade. While silver remains exempt from direct tariffs as a monetary metal, the 15% global tax has fueled massive domestic inflation. The January Producer Price Index, PPI, data, released this week, showed core inflation surging 0.8%, nearly 3 times the expected reading. As the dollar's purchasing power is eroded by trade protectionism, silver has surged back from its $64 lows to trade above $93 per ounce as of February 27th. What makes the 2026 silver crisis different from the Hunt Brothers squeeze of 1980 is the foundation of price-insensitive industrial demand. We are currently in the sixth consecutive year of a global silver deficit. Industrial fabrication now accounts for nearly 60% of total global demand, consuming 680 million ounces in 2024, and projected to climb even higher this year. The primary engine of this scarcity is the artificial intelligence infrastructure build-out. AI training servers require approximately 3.5 times more silver-coated components than traditional cloud hardware. Because silver is the most conductive element on the periodic table, there is no viable substitute for the high-speed data transmission required by these systems. Tech giants like Samsung, NVIDIA, and Microsoft are in a global race for AI dominance, and they are prioritizing supply security over cost. Simultaneously, the automotive sector is undergoing a massive transformation. Global electric vehicle (EV) production is forecast to reach $14 to $15 million units in 2026, adding an estimated $75 million ounces of demand. A single battery electric vehicle consumes 67% to 79% more silver than an internal combustion counterpart due to complex power electronics and autonomous driving sensors. As primary silver grades at major mines continue to decline, the industry is reaching a tipping point. The world is currently running a 40 to 50 million ounce monthly silver deficit. For years, this gap was filled by liquidating stored reserves. But as the COMEX registered vaults approach zero, that buffer is gone. As Western vaults empty, the silver market is fragmenting into geopolitical blocks. On January 1, 2026, the Chinese government implemented a restrictive strategic export licensing system for refined silver. China currently controls approximately 70% of the world's refined silver output, and these new rules favor only large, state-certified producers. This policy has effectively cut global supply by an estimated 60% to 70%. The result is a dramatic price disparity. Silver in Shanghai is currently trading at a premium of more than $10 per ounce over New York spot prices. This premium acts as a vacuum, sucking physical metal out of London and New York and toward the east. Major corporations have recognized that the COMEX may no longer be a reliable source for physical metal. In October 2025, Samsung C&T Corporation bypassed the exchanges entirely, signing an exclusive 2-year offtake agreement with Silver Storm Mining to restart the La Parrilla mine in Mexico. Samsung provided $7 million in upfront financing specifically to secure 100% of the mine's silver, lead, and zinc concentrates. This vertical integration is becoming the new standard. Even BHP, one of the world's largest mining companies, recently entered into a massive silver streaming agreement with Wheaton Precious Metals involving a $4.3 billion upfront payment, the largest in history. When the world's biggest tech companies and miners start making private deals for silver, they are effectively voting against the transparency and liquidity of the paper exchange system. A final, looming factor for the silver market is the rise of state-level asset sovereignty. In February 2026, Texas officially launched a first-of-its-kind sovereign distributor program. Through an official state storefront, the public can now purchase state-branded Lone Star gold and silver coins directly from the Texas Bullion Depository. This initiative includes Texas gold bills, thin, durable notes containing verifiable layers of 24-karat gold, and silver specie that can be spent via a digital payments platform integrated with the state's depository. This allows Texans to bypass traditional commercial banking rails entirely and hold their wealth in a state-administered, physical alternative. Under these new rules, banks can count allocated physical gold at 100% of its market value toward their liquidity reserves, placing it on par with cash. While silver has not yet received the same Tier 1 status, it is being treated as strategic infrastructure. The United States recently added silver to its official list of critical minerals, signaling that future trade policy may include price floors or direct government stockpiling to protect national defense and energy sectors. The technical picture for silver is what analysts are calling beast mode. Following the rebound from the January lows, silver has established a sequence of higher lows and has broken out above its 50-day moving average. The immediate technical target is the $91.27 resistance zone. A decisive daily close above this level clears the path toward $95.22 and the psychological $100 handle, with the gold-to-silver ratio narrowing to the 57 to 58 range, down from historical averages above 80. it is clear that silver is currently the highest alpha asset in the global commodity complex. The March Madness of 2026 is no longer just a delivery cycle. It is a stress test for the entire Western financial architecture. If the COMEX cannot deliver the metal requested, it may be forced to declare force majeure and settle contracts in cash. While legally permitted, such an event would be psychologically catastrophic, confirming that paper silver is merely leverage, while physical silver is the only reality. The world is currently running a monthly deficit of $50 million ounces, and the vaults are nearly empty. In a global power contest over technology and energy, the era of cheap silver has come to a definitive end.